This is Nightly Business Report with Sue Herrera and Bill Griffin.
Stocks plunge. The Dow tanks, falling nearly 800 points as investors run from equities in one of the worst days for the market this year.
Recession warning. The bond market sends a stark message to investors, but what's really going on inside the economy?
Housing hurt. A leading luxury home builder says sales could be in for a long winter chill. Those stories and much more tonight on Nightly Business Report for this Tuesday, December the 4th.
Good evening, everyone, and welcome. Stocks were battered and bruised. The reason wasn't just trade, though that didn't help. Today, a big focus was on the bond market, which some say is signaling a slowdown in economic growth. The word recession is even being thrown around. The retreat from stocks was broad. All of the major indexes fell more than 3%, with the financial sector getting hit the hardest. Let's get right to the closing numbers. The Dow Jones Industrial Average plunged 799 points to 25,027. The Nasdaq was down 283, and the S&P 500 slipped 90.
So what exactly happened in the Treasury market that sent stocks plummeting like this? Steve Leisman takes a look at what the bond market may be signaling.
Among the big worries that helped push markets to a big decline Tuesday is what's called an inverted yield curve. Sounds complicated, but it's a technical term that means a long-term bond like the 10-year yields less than a shorter-term bond like the 2. It's supposed to be the other way around. It's called the 2-10 spread. Once the difference is negative, it has an almost perfect record of predicting a recession from a year to 18 months out. It's not quite negative yet, but with the 10-year yielding around 2.9% and the 2-year at 2.8, the difference between the two is as small as it's been since 2007. That was on the eve of the financial crisis. So what's troubling the market?
I do think the bond market is sniffing out a continuation of the slowdown in growth we're already seeing, and possibly a moderation or a topping out in the inflation trends, particularly with the drop in oil and core PCE that we just saw last week that showed a little coming off of the edge.
After celebrating the weekend trade talks between Presidents Xi and Trump, a second look by the market suggested there might be less to the agreement than first met the eye. That creates the possibility that the U.S. and China will be on the verge of another trade war just 90 days from now. Second, economies are slowing, especially abroad, and investors don't quite have a read on how much U.S. growth will ease back as a result. Third, all of this has investors trying to game out how the Federal Reserve will react by pushing ahead on raising rates or easing up on those rate hike plans. While an inversion has a good record of predicting recession, the history suggests there is no recession signal if the difference between the 2 and the 10 remains positive. And it is still positive, so there's still a chance this is a false signal. For Nightly Business Report, I'm Steve Leisman.
Those trade concerns that Steve just mentioned were acknowledged today by the Treasury Secretary at the Wall Street Journal's CEO Council meeting.
I think the market is now in a wait and see, and the market's trying to figure out, is there going to be a real deal at the end of 90 days or not? And I will tell you there are very, very specific issues that the president agreed on, okay, but now have to be dealt with on specific wording. For the first time, China agreed that to a concept of specific time frames, specific deliverables, and penalties if they don't respond. Now, whether we can get that to a real agreement, or at least make a lot of progress over the 90-day period or not, time will tell.
Trade-sensitive stocks like Caterpillar, Boeing, and 3M were all lower in today's session.
Well, let's talk about this market sell-off. Bob Pisani, who usually is at the New York Stock Exchange, is actually with us in studio tonight.
I made a wrong turn on the West Side Highway, and suddenly I'm here.
And we're forever grateful
happy
about that. What's the mood of the market? What's this message that the market's telling us that you can tell from traders downtown?
Slower growth is the main message, and continued concerns about tariffs. I heard Mr. Mnuchin there. We don't have a deal, and the market is a bit skeptical.
Even though the economic data is still looking pretty good right now.
The U.S. economic data is looking very good. But remember, you know this, analysts, the market's a discounting mechanism. We're trying to figure out what's the 2019 earnings picture going to look like. Right now, analysts think it's not going to be a bad year, up about 10%. But there are certain signs globally, China and in Europe, that the numbers are not going to be as strong as people think. Some people, Morgan Stanley, for example, they have 4% earnings growth. Now, remember, the market moves on what the earnings are going to look like a year from now. And if you're talking about 4% instead of 10%, the market's going to have a problem. And that's the problem. We can't figure out what's the tariffs going to be and what kind of global growth or slowness are we going to get. A little bit better picture on the Fed and raising rates, but those two X factors are really causing a lot of gyrations.
That's what I was going to ask you about the Fed, because does a day like today, coupled with the worry about slowing economic growth, do you think it changes the dynamic for the Fed or not quite yet?
Well, no, there are people who are out who will say, yes, that's going to change the way the Fed's thinking. But in theory, that's not bad news. The Fed's going to go even slower than people thought. So two things happened today. First, we hit a very important technical level about noon, the 200-day moving average for the S&P 500. When you drop below that, that tends to indicate slower growth. Also, we've had that flatter yield curve where the 10-year yield has actually been coming down recently. Right. Historically, that's also indicated slower growth. So wait a minute. We get two indicators that historically has indicated somewhat slower growth. This tells momentum traders, guys who trade on how growth is doing, slow down a little bit, take some risk off. And that's essentially what we had. The market went down notably when we hit that 200-day moving average.
Good to have you here.
Pleasure.
Thank you, Bob Pisani, joining us tonight.
While concerns over a slowdown dominated trading today, not everybody is worried, because today we heard from the Commerce Secretary and two big bank CEOs, all of whom said the economy is doing just fine.
The economy itself is really strong. You've seen the unemployment figures, you've seen the new claims, you've seen industrial production, you've seen executive confidence, you've seen consumer confidence. Those are all very, very high.
We feel very good about the U.S. economy. The predictions will slow a little bit, but underneath that is a strong growth rate that we feel very strong about.
We've been in a long economic recovery. It's been a little bit more muted than prior economic recoveries. That may mean it's going to last a bit longer, but I think we need to be very wary of the fact that at some point we're going to have a cycle. What we see today in the economy, what we're seeing from our customers, is generally positive, and so we're not overly concerned.
So what's really happening in this economy? Peter Bookvar, Chief Investment Officer with the Bleakley Advisory Group, joins us. He was, as you know, in Steve Leisman's report earlier. He's back with us. And Ian Shepherdson, Chief Economist at Pantheon Macroeconomics, joins us as well. Ian, let me start with you. How do you view the economy at this point? And is the market really reading it completely wrong?
Completely wrong is probably overdoing it, but I do think all this talk of slowdown or, heaven forbid, an imminent recession really is overdone. There's a couple of pockets of weakness, housing in particular, but I think even there, probably it's been distorted by Hurricanes Florence and Michael, which have hit the recent numbers. Apart from that, yeah, there has to be some slowdown because the tax cuts gave us really strong second and third quarters, but we're not going to go from those very strong numbers into some sort of rollover. We're going to go back to something probably in the middle or high 2% for GDP growth. And that's fine. That's probably enough to keep the unemployment rate, which, remember, is already at a 49-year low, continuing on a downward track, heading towards 3.5% or even 3.25%, which to me is a pretty remarkably strong story.
Peter, you've been long looking at global growth and that's been a problem. And now it's starting to creep to us, I guess, or at least that's what the market senses, right?
Global trade has clearly slowed. In the third quarter alone, we had economic contractions in Japan, in Germany, in Sweden, in Switzerland, in Italy. Now, some of that with respect to Japan and Germany will rebound in the fourth quarter, but those are a bunch of countries that saw a decline in economic activity in Q3. But there's no question that exports and global trade has slowed. A lot of it has to do with the tariffs. A lot of it has to do with China just naturally slowing in a deleveraging process. But that is now beginning to affect U.S. growth. It's certainly going to affect U.S. trade because we do obviously rely on exports with about 15% of the U.S. economy.
So, Ian, what about that? Can the U.S. economy weather a global slowdown from the likes of India and China, and to a certain extent parts of Europe as well?
There's a hit from those things, but 85% of the economy is domestic is the other way of looking at it. And the domestic side of the economy really is still pretty strong. The great uncertainty, of course, is tariffs, because they could turn this whole story upside down. If in 90 days' time the tariff on Chinese imports goes from 10% to 25%, as the administration's threatening, then we'll have a much more serious slowdown. It will be absolutely chaotic. My guess is that this is a big bluff game, and that actually we'll pull back from the brink and probably extend that negotiating period further. I don't think either China or the US really want to go down the rabbit hole of huge tariffs on everything. It's just too dangerous. Both economies are suffering from it, but equally, if we take that threat away, both economies will do better.
Peter, if we're going to see a slowdown here, where do we see it first? Which sectors typically lead a slowdown?
Well, I think capital spending is at risk because of the uncertainty with respect to tariffs and the growth slowdown that we're seeing overseas. I think another key thing is, what does the stock market do? The consumer has been really the driving force. We are a very asset price dependent economy. If the stock market continues to go through this turbulence, if the sell-off actually continues, that in itself could start to affect consumer spending behavior. We've already seen a slowdown, as Ian mentioned, in housing. We're seeing a plateau in autos. You see a further decline in the stock market, and I can guarantee not only is it going to affect consumer behavior, but it's also going to affect corporate behavior, because if you're the CFO and the CEO that sees a decline in the stock market, you're going to take a pause.
Transportation stocks were very weak today. The transport average had its biggest point decline ever today. So there's one indicator right there, I guess.
Absolutely. A good proxy for not only domestic trade, but also international trade.
Weigh in on that, Ian. Do you agree?
Well, certainly, I don't want to see the stock market keep falling. Another few days like today, it's going to get very difficult very quickly. But my guess is that today was mostly a reaction to the president's tweets about tariffs, when he called himself tariff man and kind of turned upside down all the warm thoughts that we had over the weekend from the meeting with Xi Jinping. So I suspect we'll be walking back from some of that language over the next few days, and hopefully things will settle down again. But I mean, it's pretty clear that the peak of earnings growth is now gone, and this question of what happens to earnings growth next year really is becoming very pressing. But I think some of these forecasts that we're seeing now are getting to be a little bit too bearish, and I'm not ready yet to call a meaningful turn in the economic cycle. I think that the domestic story has still got some legs for a while yet.
On that note, gentlemen, thank you so much. Peter Bookvar with the Bleakley Advisory Group and Ian Shepherdson with Pantheon Macroeconomics.
Well, it's time to take a look at some of today's upgrades and downgrades. We begin with Intel, which was downgraded to underperform from market perform at Northland. The analyst there says weak demand will slow growth, and he added that, and we're quoting here, it takes Intel forever to turn the ship and even longer to change momentum. Price target now $42. That stock fell more than 4.5% today to $47.75. Morgan Stanley cut its price targets on FedEx to $232 and UPS to $87. The analyst cited competition from Amazon Air. The firm says that Amazon Air could steal as much as 10% of the two shipping giants' revenue by 2025. Shares of FedEx fell 6%. UPS dropped 7%, and as we mentioned, that took down the broader Dow transport average, which suffered its biggest ever point decline today. Meanwhile, Apple was downgraded to hold from buy at HSBC, with the analyst citing too much dependence on a single product, namely the iPhone, and the reality of what he called market saturation. Price target now $200, and the stock closed below that level at $176.69.
And speaking of Apple, have iPhone sales indeed peaked? Still ahead, what that could mean for shares of one of the most widely held stocks.
German auto executives went to the White House today, including the heads of Daimler and Volkswagen. They were there to discuss the Trump administration's threats to impose new tariffs on European-made vehicles. But Daimler has said that it planned U.S. investments. They are contingent upon no new trade barriers. And the CEO of Volkswagen said today he's working on an alliance with Ford, which would increase capacity here in the United States.
Another Apple supplier is warning of slowing sales. Audio chipmaker Cirrus Logic said weakness in the smartphone market would cause earnings for the third quarter to come in lower than expected. This comes on the heels of several Apple suppliers reducing their financial outlooks in recent weeks. Shares of Cirrus Logic finished the day down nearly 2%.
And Apple is now reportedly turning to promotions to drive sales of iPhones. Bloomberg is reporting now that the tech giant has instructed some of its marketing staff to stop working on current projects so that it can focus on improving demand for the company's newest iPhones. Since that initiative, Apple has indeed offered consumers a number of trade-in offers that reduce the price on some of the iPhones currently for sale.
So does all of that mean that the company may have reached peak iPhone sales? And if so, what will it mean for the stock? We're joined tonight by Timothy Lesko, principal at Granite Investment Advisors. Tim, welcome. Nice to have you here.
Thanks for having me.
Weigh in on the debate. Is it that iPhone sales have peaked, or people are just waiting longer to upgrade or renew with a new phone? How do you feel about it?
Well, I think that you're finding that with the higher priced iPhones and with the cycle seemingly stretching out where people might be waiting 2 or 3 years to upgrade their iPhone, that there's a concern out there that that's going to mean a massive decline in iPhone sales. And I think that really maybe isn't in the, baked in the cake. Apple grows internationally. So I think these analysts are taking a very US-centric view of a product that is sold around the world with plenty of growth opportunities.
I can hear Tim Cook now. He has said for years that Wall Street just doesn't understand their growth strategy. Yes, hardware sales have been slowing down, but it's the services, the ecosystem that feeds those services that are really the growth future for this company. What do you think about that?
I think he's absolutely right. I think what Apple wants to be is the operating system for everything that you do digitally, whether it be your smartphone, certainly as their lead product, but also as your computer, your tablet, your watch, eventually your car, perhaps your automated car, your thermostat, and your smoke detector. So, even if iPhone sales begin to slow, it's not because people are buying a different phone or moving to a different operating system. They're staying within the ecosphere, which really creates long-term opportunity for Apple to continue to sell them both other products and services.
So what do you do with the stock? We just said that HSBC downgraded the stock today. It took a hit. If indeed there is still this global growth with India, with China, with other parts of the globe, do you add to a position here if you're a long-term investor?
Certainly if you're a long-term investor. Sales of almost every product can be cyclical. As long as this isn't a secular change in the way people interact with technology, then you just have to take it as a cyclical weakness in a product or perhaps at a price point. The other thing facing all cell phone manufacturers is in a year and a half, we're going to have widespread 5G cellular service, which is going to force everybody to want to upgrade their cell phone. So I think Apple was wise to stop telling people how many iPhones they sell, because you probably see a meaningful decline over the next 18 months until those 5G phones come on.
Tim, thanks so much. Appreciate it. Timothy Lesko with Granite Investment Advisors. Bill?
Now to the housing market and a weak report from Toll Brothers, which added to today's overall concern in the stock market. The luxury home builder reported its first decline in quarterly orders in more than 4 years, and it issued a downbeat outlook as well. Diana Olick has more.
Apparently, the luxury home market is not immune to the widespread weakness in housing right now. Toll Brothers, whose average home price is about 3 times the national average, reported new orders down 13% from a year ago in its last quarter. It also gave lower expectations for 2019 than the street was expecting.
In November, we saw the market further soften, which we attribute to the cumulative impact of rising interest rates, rising home prices, and the effect on buyer sentiment of well-publicized data of a housing slowdown.
Analysts, however, point out that we've been seeing a slowdown in housing all year. This is just the first time Toll acknowledged it, showing that luxury is also sensitive to rising mortgage rates, which took a large leap in the last 3 months. As for the well-publicized reports, they've come from all sectors of the housing industry. The home builders, the U.S. Census, the realtors, Fannie Mae. All have reported weakness in home sales and pointed squarely to affordability now at the lowest level in a decade. Even Toll noted the most weakness in California, where home prices are highest.
Significant price appreciation over the past few years in California, fewer foreign buyers in certain communities, and the impact of rising interest rates all contributed to this slowdown.
On the bright side, those hot home price gains are now cooling, which should help more people afford to buy. Except now that prices are cooling, more people want to wait it out, afraid that if they buy now, they'll lose money. For Nightly Business Report, I'm Diana Olick in Washington.
Dollar General's bottom line was hit by hurricanes, and that's where we begin tonight's market focus. The discount chain cut its profit and sales outlook for the year, citing storm-related losses. The retailer says many of its stores were damaged by extreme weather in the southeast, and the company also warned of higher freight costs. The stock fell more than 6.5% to 104.10. AutoZone reported a 25% rise in earnings, which surpassed analysts' expectations. Same-store sales at the auto parts retailer were also better than expected. Shares bucked the broader market trend, rising more than 6% to 880.07.
Delta expects a key revenue metric to fall short of expectations. The airline says that fourth quarter unit revenue will rise 3 to 5% despite recent declines in fuel prices. And that's adding to investor concerns about the industry's ability to manage this decline in oil prices we have seen. That stock fell 5% today to 56.94. Also, after the bell tonight, computer maker Hewlett-Packard topped Wall Street's profit expectations as the company sold more storage and data center products. Total sales also grew at a faster than expected pace, and shares were up initially in the after hours, but finished the regular session down nearly 3% to 23.24.
Oil prices settled slightly higher today after a volatile session. As we reported yesterday, there is the expectation that oil producers could reduce output at an upcoming meeting this week, a meeting that is taking on greater importance. Jackie DeAngelis explains.
Just days away from a crucial OPEC meeting in Vienna, and news this week that Qatar intends to withdraw from the cartel. Qatar, the world's largest natural gas producer, is a relatively small oil producer, but still, the move is significant. Qatar is separating itself from OPEC after clashes with Saudi Arabia. The country says the move is strategic and not political, but either way, it makes a powerful statement. Qatar is forging ahead with its own plans for its energy businesses, and in a new dynamic landscape fueled by the U.S. shale revolution, the implication is the old way of doing business no longer applies. The move also raises questions. Will other OPEC members follow suit, putting their own interests ahead of the group to try to fight a war on energy pricing that has gotten more intense?
And the most important part of this is the increased oil production out of the USA. It used to be that OPEC was the only game in town, and they had almost absolute control of prices. Now they do not. Are they still powerful? Of course they are. Has their power lessened by a lot? So the fact that Qatar is left is interesting to me, and it could be a sign that people are looking at OPEC saying, you're not the only game in town any longer.
Oil prices dropped under $50 a barrel just recently as concerns of oversupply and waning demand have hit the markets again. When oil prices drop, producers globally struggle and face difficult decisions on production levels. It's been a back and forth playing out over the last few years. Canada just announced a production cut in Alberta, suffering from low prices, taking matters into its own hands. Experts say the move shows producers are at a loss on what to do. And Thursday, OPEC meets. The expectation is for a cut of a little more than 1 million barrels to support prices over 50. But does a cut that comes on an inflated base really matter?
I think that there's people who will have to shorten up their positions prior to the meeting, and I think oil could spike up to $56 prior to that. Does the story itself matter? I don't think it matters that much. What really happens and what they say is going to happen, that takes months to figure it out. But I think we could have a spike in prices prior to the meeting.
While much is uncertain, one thing is for sure. Times are changing in the oil patch and the players are changing course. Qatar is just the latest example of the crack in OPEC's armor. For Nightly Business Report, I'm Jackie DeAngelis.
Coming up, expanding economic opportunities for at-risk kids.
Well, it was an ugly market day, but we have a story now about giving back. At the center is an organization in the Bronx that received a grant from the Chan Zuckerberg Initiative and the Rockefeller Foundation. Kate Rogers has all the details.
These young people here in the Bronx are getting a second chance.
Take your time.
They're participating in a program called Bronx Connect, which works to keep at-risk youth out of the criminal justice system and reduce youth incarceration. Bronx Connect does just that. It connects these young adults with positive community resources like mentors, even job training, when many may have little else.
Sometimes in dysfunctional homes, so they don't really want to go home and deal with whatever they're dealing with, so some of them stay on the streets.
Bronx Connect is one of 10 grantees awarded $1 million each from the community's Thrive Challenge, led by the Chan Zuckerberg Initiative and the Rockefeller Foundation. These organizations are turning to community leaders to solve economic and social issues ranging from disenfranchisement to financial literacy.
It's incredibly important to understand these complex issues and the real barriers that actually prevent individuals from being successful. And the folks who are best positioned to actually know and address these questions are folks who are already embedded in the community.
Part of the premise of the challenge is that even in a strong economic environment, many are being left behind.
A generation, 2 generations ago, people had much more economic mobility and opportunity in America than we do today.
Bronx Connect is already seeing success. Participants in its Alternative to Incarceration program had only 17% recidivism rates over the course of a year, compared to 76% for youth incarcerated in the city.
They're completely rethinking the way that we address the needs of young people when they commit misdemeanors and felonies. And they take it as an opportunity to actually give the mentorship, give the opportunities for education for kids to actually then move forward in their lives.
He started working on it's been like a month now, right?
And with the grant money, they're hoping to help even more people.
We all know that when we were young, we might have made a mistake. So we want someone to give us a second chance and point us to a better direction than just punishing us.
For Nightly Business Report, I'm Kate Rogers in New York City.
And one final look at what turned out to be the worst day of the market this year, with each of the major averages down more than 3%.
That's it for Nightly Business Report. I'm Sue Herrera.
I'm Bill Griffith. Have a great evening. See you tomorrow.